Everyone tells you mutual funds are the safe bet for retirement. But what if they told you they actually have almost a 99% failure rate? And that could quietly destroy your shot at financial freedom. So let's separate risk from failure and talk about what actually works. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you if you want your money working harder for you so you don't have to work so hard for that money. You want to become work optional where you work because you want to, not because you have to. All right, so let's talk about this. Like, why investing in mutual funds have a 99% chance of failure, right? And what actually works. And that's what I really want to talk about in this episode is I want to get into, what's going on with mutual funds. What's the difference between risk and failure, right? There's two very different things. And of course, what actually could give you the best results. Now, this kind of came up in my mind because I was talking to somebody pretty candidly about real estate. This is actually at our annual event for our clients. We have these one-on-one clients that come and gather together once a year, and we talk about this. And the thing I admitted flat out was, it's when we talk about alternative investments like real estate and things like that, it's not risk-free. In fact, I mean, if you look at the definition of risk, risk is chance of loss, right? What's your chance of losing money in a particular investment or a savings vehicle for that matter, right? Versus failure, which is what's the odds that you're actually going to succeed and get your goal? For example, if you want financial freedom, what's your actual chance of success versus failure? So let me give you an example here. Say that you put your money all into a savings account, earning your point nothing percent. Now, what's the chance of loss? What's the risk rate on that? It's pretty much just about zero, right? You have FDIC insurance, plus savings in general generally are low risk type of things. You're pretty much looking at Armageddon or something pretty drastic to lose your savings, right? That's correct there. So again, zero risk or almost zero risk. I don't want to say zero, but almost zero risk. But what's the failure rate? Can you become financially free just saving your savings account? And we all know the answer. The answer is no, not at all. So even though there's almost a zero risk rate, there's also about a 0%. Well, really, there's a 100% failure rate, right? 0% success, 100% failure. So that's an example right there. So we know that we are never going to save in savings accounts just to be able to save for retirement or whatever it might be, or financial freedom, because it'll never be enough. So what do most people do? They go for mutual funds. Now, here's an interesting thing about mutual funds. When it comes to risk, chance of loss, short term, yeah, there's absolutely a lot of risk with mutual funds. Longer term, however, what's the chance of you actually losing money, let's say in 15, 20 years? Historically speaking, if you look at any 15-year period, we have to go at least 15 years because we know there's 10-year periods that have lost money, but any 15-year period, we haven't seen anybody lose money if they're in the S&P 500, right? They've at least had just as much, if not a little bit more by that point. 20 years, there's no risk in that sense. Now, does it mean that you don't have the odds that it could happen to you? Of course, there could be odds that you lose it. Now, losing all of your money, that is less likely, right? It's very unlikely that in an S&P 500, your value is going to go to zero. That's the one good thing about mutual funds is that you won't lose everything. Now, could you lose a lot? Absolutely. Could you lose at the wrong time right before you need it? Absolutely. And so that's one of the benefits of mutual funds because you are not really diversified as we've explained in past episodes. By the way, there's a lot of things we're going to talk about here that if you haven't listened to the last several months, really the last 3 months of episodes, you should go back. There's a lot of money myth things that we're going to be addressing here that mix in with this. So when we deal with that sort of thing, like, yeah, there's not the risk you're going to lose all your money. That's pretty unlikely. You buy an individual stock, could happen. Doesn't always, but it definitely could happen, right? We've seen that happen before in history. But as a mutual fund, generally going to zero is pretty much unlikely. If not, I wouldn't say impossible, but it's very improbable. But what's the success rate? Is there a failure rate there? Now, I've quoted many times, I even gave you the updated quote about Fidelity. They came out with their new numbers that now there's over 1 million of their clients, right? Out of 45 million, there's now over 1 million people that have at least $1 million in there. But remember, Transamerica did a study of these same people, and 35% said it would take a miracle to be able to retire. So over a third, and that's just the ones that say it'll take a miracle. That's not even the ones that have doubts that they'll be able to retire, comfortably. And as a result, even though, do the math, right? 1 million people, that have $1 million out of 45 million is just over 2%. But when you see nearly half of them saying, yeah, I'm not going to be able to make it, that means that only about a 1% success rate of true, real financial freedom, right? Where people feel free. This doesn't mean you can't survive on the money. I wanted to get this straight. It doesn't mean you can't survive, but it doesn't mean you're going to feel like you can live a lot on that money, right? You're going to be living very strict. You're going to need Social Security to help you out to do that. Because if you didn't have Social Security, a lot of other people would then be scared, absolutely scared out of their mind. If we drop Social Security today, I'm not saying that's happening, there would be a lot of people saying, now I'm scared. Now I won't be able to make it because they needed the Social Security to bridge the gap of what they weren't getting in the mutual funds. So that's that's why I say it's nearly a 99% chance of failure, right? Much like the savings account, it's still better than a savings account by far, no doubt. That being said, though, because of inflation, because of taxes too, because there are no tax advantages unless you have a Roth IRA, but you really can't save enough in a Roth IRA to do that unless you do the whole backdoor Roth thing. But again, jumping through extra hoops, it's pretty tough to do that, and you still have to pay taxes on that money, which you may or may not want to do. And so there's not really a tax benefit when it comes to the mutual funds or anything in the stock market for that matter. And so that's why I say there's roughly about a 99% failure rate. But risk, I would say risk in mutual funds compared to what we talk about with alternative investments in real estate, the risk is better with mutual funds than with real estate. Because the truth is, in certain real estate deals, not all, but certain real estate deals, you could absolutely lose all of your money. I know I've been in deals that's happened. I've had clients that have been in deals where they've actually seen that happen on a rare occasion, but it does happen. And so when it comes to risk or chance of loss, yes, yeah, an individual real estate type of deal is higher risk than a mutual fund. Now, this might shock some of you that I said this. It might actually relieve some of you that I said this because if you're being candid and being honest, and this is what I brought up in that event, is that it's true. You can lose all of your money in certain types of real estate deals. Could you lose all your money in buying a rental property? Less likely, right? If you go for a rental property, because if you do have that money down, now that down payment, if there is depreciation and all that equity disappears, you could lose money there. But are you going to lose all of it? Maybe, maybe not. If you choose not to sell, if you have enough cash flow coming in from the rent, assuming it's a rental, then yes, you might have enough cash flow coming in that you can weather that storm and you're still getting paid. But if you buy something all out in cash, then your chance of it going to zero is almost nothing unless you literally buy no insurance on that property. It burns to the ground and you get nothing. You just have the plot of land. And even then you might get a few bucks for it. Yeah. So even a 100% loss is not as likely. But there are deals like we've talked about syndications, people pulling money together, put into an apartment building. If you're just putting that money in as equity, but there's also debt on that property, and then the values drop like we've seen happen in the last 3 years, it is possible to lose all of your money as an equity play. This is why we've often shown our clients to do more debt type investments. But even then, even if you have debt on a property that you're like the mortgage holder on that property and that real estate investor doesn't pay you back, you could foreclose and take that property back. Assuming you have equity, you could lessen that risk and try not to lose any, if anything, get more gains than you might have had anyways, right? So there's ways to lessen your risk in different types of deals, but there are deals that you absolutely do have risk of real chance of loss, of losing everything. So not just losing a little, but losing everything. Where in the mutual funds over time, and even short term, losing everything is just about improbable. I don't want to say impossible, but improbable. Does that make sense? So really when it comes to risk, chance of loss, mutual funds are better than real estate. But when it comes to the failure rate is much, much higher on mutual funds than it is with doing things in the alternative investment space because alternative investments can pay real stable cash flow. And the type of things that we talk about with our clients, that's the kind of thing we talk about with them is how do we actually create real income? For example, those people that actually do save $1 million, which again, we've seen in Fidelity is only 2% of their clients have $1 million or more. Well, of that $1 million, then you're told to live on 3% a year. That's $30,000 a year. That might still be a failure rate for you because with inflation and everything else, you can't live on that. Now, I know there's somebody going to say there's always an exception. I get that. That's why I say nearly 99% because I know there's always exceptions, right? But I'm using the numbers because realistically in most areas, and somebody has a family and they're married and, versus being single, even some people are single too, want to live on more than 30,000 a year, right? I think you would agree with me on that one for sure. Now, If you have $2 million, great, you can live on 60,000 a year. But here's the thing: you have $2 million, you earn 10% in an alternative investment. They're not touching your principal, and it's not like the market goes up and down. That's why mutual funds has to be a lot less because it's got to weather the ups and the downs. They got to weather those storms. Or if you decide to pull your money out of the market, then you go in things like bonds and treasuries, which might only be paying you around 3-4%, and you're trying to factor in for inflation, all this other stuff, right? And we're not even talking about taxes. So that's why it's the 3% for your in your 60s, 4% if you're in your 70s. And I'm going to get back to that in a second. So I'm trying to explain this because I'm going to show you the numbers of how it looks. But even just conceptually, right? That $2 million person, yeah, they could live on 60,000 a year, pulling out 3% of the mutual funds, or that 2 million makes 10% a year because many investments will pay at least 10%. Well, that 10% then is paying them 200,000 a year, not 60, 200. It's like triple the income. And just so you know, that's not like just a difference of 3% to 10%, 7%. That's over triple. That's a 333% extra gain on your money. The same money, just working harder. That's why we talk about get your money working harder for you, so you don't have to work so hard for that money. Now, let's talk about what that looks like. And I want to use 3 different scenarios because I know that we've kind of talked about what this is. But remember, I just did a podcast talking about where you could create tax-free income using life insurance. I thought, wouldn't that be interesting? Let's talk about 600,000, which, by the way, 600,000 is the average 401k and IRA balance of a Gen Xer right now, which is my generation and a lot of people that are getting close to retirement. So let's use that same $600,000 example. What would it look like in 10 years, right? Let's assume you're 50, you want to retire at 60, right? And you've got that 600,000 and you want to put it away. Now, remember this, the other risk we have in the stock market right now is that even Vanguard only predicts a 2.8 to 4.8% average return for the next 10 years. That's Vanguard. They usually like to make it rosy. I'm going to play devil's advocate against my own point and show you what if you earn even better than their predictions, even though the market's running out of steam, even though it really having a hard time going up higher. Let's just pretend that it does, but maybe it makes a 6% rate of return. Let's show you what that looks like. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. Okay, so you see $600,000. We have it at 6% interest rate over 10 years. So I'm putting this higher than I predicted. I should go lower, but I'm going to keep it higher just for the sake of this. Notice that 600,000 in 10 years would grow to just over $1 million, right? So this would get you to just over that $30,000 a year, about $32,000 to be exact. Now, if I do lower it to 5%, then we're going to see this thing drop to just below $1 million. So notice just 1% difference makes a massive difference. So at best, we might be hoping for around, and actually, you know what? I'm going to be better. I'm going to be devil's advocate times 2. So not only am I going to give a higher interest rate than what they're predicting, I'm also going to say it's a 4% withdrawal rate, right? That you're going to be able to pull out 4% a year. And the reason is because I'm showing you a 20-year scenario on one of these, pulling out for 20 years. I'm going to say 4% a year would be just fine. So 4% on this would be $40,000 a year. May or may not have tax benefits depending on where that money's being held. But if it's just in mutual funds, IRAs, 401ks, you also have to pay taxes on that $40,000. Now, what about a scenario, if you guys recall from last time, I had a scenario where I showed, using life insurance. And so let's bring that one up, again, where I showed them putting in $600,000 up front, has a 5.5% returning account that pays into that, but it pays over 10 years. So even though it's $600,000 up front, in 10 years, what do you have? Okay, now you see $75,000 a year going in. Well, that's because this account is fixed for 10 years, paying 5.5%. So it's paying into it $75,000 a year, even though you put in $600,000 up front. Now that $600,000 eventually becomes $879,000. So this is roughly at least $100,000 less than the mutual fund. But remember, it's not about how much is there. It's about how much you can actually live on. What's the actual income you can get, right? How do you get your money working harder? Well, because it's a guaranteed place, right? There's a lot. By the way, if you talk about life insurance, whole life specifically, right? You have to be very specific. Universal life, there's higher risk. There's higher chance of losing. But with whole life insurance, there is not the chance of loss. In fact, it's less than even a bank savings account because they have reinsurance backing them up. They've got other things in place, and they have minimum guarantees of at least paying you 3% a year, which is better than what the savings account will promise you. They'll probably pay you at least 0.01% a year, which they've done to us in the past. But this one will bottom out at 3 or 4%, depending on the kind of insurance you get. And by the way, I pick companies that have paid more than their minimum for the last 100 years plus. So in this case, 879,000 just based on the current rates, the current interest rate that's being paid right now. So yes, that's less, but look at the income. The income is $65,651 per year for the next 20 years, tax free. That's tax free income at over 65,000 a year. That's definitely better than even what we saw before. 4% on about $1 million in the market would be 40,000 a year that you may not even have. You might also have to pay taxes on as well, right? So that's something where you might be able to make double the money just in life insurance. So even just from that standpoint, for the next 10 years, you might be better off. And by the way, that was on a 60-year-old. I should have done on a 50-year-old. The ROI would be a little bit better. So you'd actually make more money. But again, I'm just playing devil's advocate against my own point here that even with mutual funds giving the benefit of the doubt, giving them a 4% rule versus the 3%, giving them, even if you don't pay taxes, right? And of course, even giving the benefit of 6% versus, 2 to 4%, like they're predicting average, right? All of that still, even just life insurance beats it. Now, is that necessarily going to have a good failure rate or not, right? Is there going to be a success rate here? That's debatable, right? Because 65,000 in 10 years, you might say, okay, that's okay, but that may not be enough to live on even in 10 years. But it's a sure heck of a lot better than living on 30, 40,000 a year, right? If you're in the stock market, even after 10 years of growth on that 600,000. Now, what if we did this? What if we invest that money into things we talk about, like 10%, but maybe you defer it. Maybe you just say, hey, I am 50. It's even in an IRA. I'm going to defer it till 60 to when I can pull that money out. I'll pay taxes, but let's just see what that looks like. Well, now you're earning a 10% rate of return. It's going to compound for the next 10 years. And yes, there are funds you can put money in for 3 to 5 years, reinvest it during that period of time. And some of them do pay more than 10%. I'm keeping it low at 10%. What do you get? You get $1.5 million, $1.55 million. What does that mean for an income stream? That means that literally you're earning 10% on that, which is $155,000. Guys, that's a heck of a lot better than 30 to 40,000 in the stock market. And it's even better than life insurance. Now, here's the thing. There is a chance of failure, right? There is a chance that you could lose money at any time. Now, usually when we work with clients, we don't just say throw all 600,000 in this one deal, right? We wouldn't do that. We would split it up in different places because there is a failure rate. There'd be a failure rate if you just put it in one deal and then with the high risk could lose it all, right? And when I say high risk, this is also debatable too, because with high risk, and I'm not gonna say high returns, but with higher risks, does depend on you as the person, as the investor. If you were to do this stuff on your own, if you were just to try to randomly just try to find all your own real estate deals, you probably will get some base hits or some home runs from time to time, but you're probably going to have a higher risk, higher chance of loss than you will working like our clients do, where they work with us, where all of us are doing due diligence on those deals, right? There's a little bit more safety in the fact that there's more people doing due diligence where you're just doing it on your own. So if you're doing this ignorantly, so to speak, right? Like not because you're an ignorant person, but just because you just don't know exactly what to look for, what you're doing, that could be high risk. So you could lose all of your money if you do something like that. With our people, there might be about a roughly 10% chance of losing, overall, like over all of our deals, most of them pay out just fine and do great. Some, even if they have issues, have little bumps, might say, hey, we're pausing interest for the next 3 to 6 months, but then they'll start paying again, right? And so even then, like you still make money on that. And so let's even lower it. Let's just say that the same person, let's just say they lost, I'm going to go high here on what we do with us. Let's say they lost a quarter of it, right? 25% is gone. So now you're down to $450,000. Well, if that were the case, that's always growing for you now. Even after 10 years, guess what? You still have 1.1 million, which is paying you almost $117,000 a year. That's still, now you might still pay taxes depending on what it's invested in, but let's assume you pay taxes. Okay, you still end up netting roughly almost 100,000 a year after paying taxes versus maybe 30 in the mutual funds or even 65,000 tax free. What's my point here, right? Is that you cannot just look at risk. You cannot just look at chance of loss. You also have to look at the failure rate, right? What's the likelihood I'm going to fail? That to me is more important than risk. Now, I want lower risk to then get higher returns and less of a failure rate, right? I do want both. This is why I use a combination of the two. I do use life insurance. I do have that. Yes, I can use it to invest, but I've also been accumulating money in that as well, knowing I can take that tax-free income at any time. I don't have to wait till I'm 60. I can take it out right now in my 40s, right? I can do that. I can also invest for cash flow, which is what I've done. I've actually done both of these things and using the combination together, some low risk plus high risk, higher risk type things, right? But then with less chance of failure because of the amount of returns we can get and the income it produces. And especially if I do it right and I diversify and I'm doing the right due diligence, guess what? Now I have the best odds of success, which is why we've had so many clients replicate this over and over and over again. And that's the thing I want you to focus on. It's like risk is one factor you got to pay attention to, but never ever ignore the failure rate. Mutual funds have a high failure rate. This is why so few people do it. Unless you're planning to save literally into the hundreds of thousands a year into your mutual funds, you're going to have a hard chance of success. Very difficult chance of succeeding. You're going to have to live on a budget. You're going to have to pare down and minimize your life to make it work. And there's plenty of people that have already been doing that. And they'll even argue and say, my mutual funds did great for me. Yes, but they need Social Security and they've had to live on less. And that's okay. That's fine. I'm not talking to somebody who wants to just minimize their life. I want to talk to somebody who actually wants to create a ripple effect. Somebody who wants more out of life, that wants to live abundantly, that doesn't ever want to worry about money or worry about what the stock market is doing from one day to the next, depending on what tariff trade war is going on or what's going on with AI and all this other kind of stuff that's going on in the world or wars or whatnot, because we know that there's more wars due to come, right? There's definitely guarantees that we're going to see the stock market have a crash, right? We haven't seen it forever, which is why we are predicting even a bigger crash than normal, because at some point it has to come back into balance. All these risk factors that are happening right now. Yes, long term. That's why they say you're in it for the long haul. Right? That's what financial advisors do to help you stay happy and content in ignorance. They try to tell you that all is well, right? All is well in Camelot. But the truth is, it's not. It's not all well in Camelot. Right now, there's a lot of risk happening, and there's a high risk if you're in the stock market right now, especially in the next 10 years or so. Longer term, if you got 40 plus years, yeah, you might be able to weather that storm just fine. But what if you didn't have to risk it all? What if you could have success today? What if you have actual cash flow today? And if you didn't want to do it today, just grow your money in a place that could actually generate better returns, paying you higher income. That is exactly what this whole show has been trying to pound into our brains, right? Is break away from that set and forget it, trying to take these higher risk, lower mediocre return mentality and get to a place where, yeah, there might be a little higher risk, but when it's done the right way, we can lessen that to where you have a higher success rate than you would ever get investing with any financial advisor or any kind of mutual fund or even the S&P index. You can do much better. So if there's anything I want you to take away is remember, there is risk, but remember there's also failure. Do not just go for something because you think there might be less risk. You want to make sure that we control our risks and increase our success. Lower risk to create higher returns, to therefore get the much higher success rate versus a failure rate. That's the thing we should focus on. Consider your failure rate, because if you keep doing the same thing that everybody else is doing, your failure rate is almost guaranteed to fail. Your plan is about guaranteed to fail, hands down. And I cannot passionately say this enough. It is guaranteed to fail. With the small few exception of you, that's your future. That's why I left financial advising. That's why I couldn't do it anymore, because I saw it. I saw the writing on the wall. I said, I know I can't teach this anymore because I know it doesn't work. I've seen the evidence over decades of people being disciplined savers and still not retiring free. If you want any odds of success, any chance of hope, right? Any real chance of hope and any chance of success, that is where you need to shift your mindset away from the set and forget mentality to a cash flow, passive income, controlling your money type of mentality. If you guys always want to know how to do that, reach out to us at moneyripples.com. But remember this, don't ignore failure rate. Do not leave it up to chance, especially when there's a bad chance in the mutual funds. Give yourself the best chance of hope and a future and something that can create and bless more lives. That is what we're here to do. That is our mission. Make sure you make it a wonderful and prosperous week. We'll see you later.